If you've ever glanced at the financial news after a Netflix earnings report, you've seen the headlines scream about subscriber numbers. Netflix adds 10 million new subscribers, stock soars. Or Netflix misses subscriber estimates, stock plummets. It's the story everyone knows. But here is the reality that most casual observers and even many investors miss. The drivers of Netflix's stock price have undergone a massive, fundamental transformation. We are no longer in the pure, growth at all costs era of the streaming wars. The market's obsession is shifting, and if you're still only watching the subscriber tally, you're looking at the rearview mirror while the road ahead has completely changed. Understanding what truly moves Netflix's valuation now is the key to making sense of its wild price swings and spotting long-term trends before the crowd. In this video, we're going to move past the simplistic headlines and dive into the three real engines driving Netflix's stock price today: the seismic shift from growth to profitability, the nuanced financial metrics that analysts are laser-focused on, and the powerful, often overlooked, force of market narrative and competitive moats. By the end, you'll have a clear framework for interpreting every Netflix earnings report like a pro, knowing exactly which numbers to watch and which headlines to ignore. Let's start with the most profound shift: the pivot from growth at any cost to sustainable, profitable growth. For over a decade, Netflix's story was simple: pour every single dollar you can borrow or earn into content to acquire more subscribers globally. Market share was the only goal. Profitability could wait. This fueled incredible stock price growth because investors were valuing future potential. However, that chapter is decisively closed. The catalyst was the great streaming awakening of 2022, when rising interest rates slammed the door on cheap capital. Suddenly, growth wasn't enough. The market demanded proof of a path to robust, lasting profits. For Netflix, this meant demonstrating it could scale its operating margins significantly while generating massive, consistent free cash flow. So, the number one driver of Netflix's stock price today is its profitability profile. Investors are obsessed with the operating margin line. Can Netflix continue to expand its margin from the mid-teens toward its long-term target of 20 to 25%? Every percentage point improvement here is a direct signal of operating leverage and pricing power, and the stock reacts accordingly. The second part of this is free cash flow. Netflix has now crossed over from a cash-burning machine to a cash-generating powerhouse. This cash is what funds share buybacks, a huge factor for the stock. Buybacks reduce the number of shares outstanding, making each remaining share more valuable. When Netflix announces an increased buyback program, it's a direct message of financial health and confidence, and the market rewards it. The pro tip here is to listen carefully to the language on the earnings call. Is management talking about disciplined investment and efficiency? That's the new growth mantra, and it's what investors want to hear. Now, let us dissect the specific financial metrics that have dethroned raw subscriber growth as the king of price movers. Yes, subscriber additions still matter, but they are now a component of a more important figure: average revenue per member, or ARM. This metric tells you how much money Netflix is actually making from each user across all its plans and regions. A company can add millions of low-priced subscribers in developing markets, but if the ARM falls, it's a red flag. Conversely, if subscriber growth is slow but ARM is rising sharply due to price hikes, crackdowns on password sharing, or a successful ad-tier adoption, that's bullish. The market will reward rising ARM over sheer subscriber volume almost every time now. The second critical metric is the growth and profitability of the advertising tier. The ad-supported plan is Netflix's biggest new growth lever in years. Investors are looking for the percentage of new sign-ups choosing the ad tier, the growth of the ads business itself, and its margin profile. A thriving ads business means Netflix can offer a lower entry price to attract users while actually making more money from them through advertising, a dual revenue stream model that Wall Street loves, because it looks like the highly profitable traditional TV model. The common mistake retail investors make is seeing a slight miss on total subscriber guidance and selling, while ignoring a massive beat on ARM and free cash flow guidance. You must look at the composite picture. The third metric is content efficiency and engagement. While hard to quantify perfectly, the market watches for management's commentary on the return on investment for big-budget shows and films. Is a $200 million film driving significant subscriber lifts and retention? The success of non-English language shows like Squid Game or The Glory is particularly watched, as they often have lower production costs but can capture global audiences, showcasing incredible efficiency. The final, and often most volatile, driver is the market narrative and competitive moat. Stock prices are not just about math, they're about psychology and story. The narrative around Netflix has shifted from disruptor to established leader navigating a maturing market. So, what stories move the stock? First, competitive threats and moats. Any sign that competitors like Disney+, Amazon Prime, or Apple TV Plus are gaining on sustainable ground can spook investors. However, more often, Netflix's stock reacts positively to signs of its deep competitive moat, its recommendation algorithm, its global production infrastructure, and its brand as the synonym for streaming. When reports show Netflix still commands the highest share of engagement in streaming, meaning people spend more time on Netflix than any other service, it reinforces the moat narrative. Second, the macroeconomic sentiment. As a consumer discretionary service, Netflix is seen as somewhat recession-resistant, but not immune. In tough economic times, investors watch for signs of downgrades from premium to ad-tier plans or increased churn. The stock can be sold off in a broad market downturn, but it can also be bought as a quality name if it's showing profit resilience. The insider secret here is to watch for inflection points in the narrative. For example, the successful execution of the paid sharing initiative, the password crackdown, completely flipped the narrative from Netflix is saturated to Netflix has untapped monetization lever. That narrative shift drove one of its biggest rallies in years. It wasn't just about the new subscribers, it was about the story changing from stagnation to a new phase of monetization. Bringing this all together, let's talk about how you should process a Netflix earnings report. First, go straight to the financial highlights and ignore the subscriber headline on the news feed. Look at the operating income and operating margin year over year. Are they expanding? Then, check the free cash flow for the quarter and the full year forecast. Is it strong and growing? Third, dive into the membership and revenue details. What was the ARM growth? What is the guidance for next quarter's revenue and operating margin? Listen to the letter to shareholders for the narrative. Are they talking about the ads business scaling? Are they announcing a new buyback? The common mistake is to react to the after-hours stock move, which is often driven by algorithms and headlines, without understanding why it's moving. Sometimes the stock drops on a beat because the guidance for the next quarter was soft on a key metric like ARM. The pro tip is to focus on the quality of earnings, not just the quantity of subscribers. Before we conclude, a critical disclaimer: this analysis is for educational and informational purposes only. It is not financial advice. Investing in individual stocks, especially volatile growth stocks like Netflix, carries substantial risk. You can lose your entire investment. The stock market is unpredictable, and past performance is never a guarantee of future results. Always conduct your own thorough research, consider your personal financial situation and risk tolerance, and consult with a qualified financial advisor before making any investment decisions. The examples given are illustrations of market principles, not recommendations to buy or sell any security. So, what drives Netflix's stock price? It's the powerful trio of profitability metrics, margins and cash flow, monetization efficiency, ARM and ads, and market narrative, competitive moats and execution. The era of judging Netflix solely by its subscriber count is over. The market now judges it by the quality of its earnings and the strength of its financial model. If you want to think like an investor, you need to make that same shift. If this deep dive helped you see the markets more clearly, do the single most helpful thing for this channel: hit that like button and subscribe for more analytical breakdowns. Let me know in the comments, which metric do you think is the most important for Netflix's future, ARM, free cash flow, or something else? Thanks for watching.